Good morning, everyone. Welcome to our Phillip Securities Research morning call. For today, we have few stock counter updates as well as technical and market trend analysis. We also have the usual macro sector outlook for Singapore weekly week 22. So without further ado, let me hand over the time to Max to talk about NVIDIA results.
Thanks, Zaid. We published our reports on NVIDIA first quarter 2024 results with the report titled AI Turbocharged Guidance. Next. Yeah, so overall, the results were within our expectations, with revenue and PATMI at 24% of our full year forecast. So jumping straight to the positive, firstly is that revenue actually beat company guidance. Revenue was down 30% year-on-year to $7.2 billion, but this was still above the company guidance of $6.5 billion. The better than expected performance was mainly due to the growth of 14% year-on-year in data center business, which also set a new record of revenue at $4.3 billion. NVIDIA said that this growth was mainly because of the increasing demand of generative AI as well as large language models across its customer base, which includes cloud service providers, consumer internet companies, as well as enterprises. Then the second positive is that NVIDIA also issued a very strong guidance for the second quarter. NVIDIA expects revenue to be at $11 billion, which is about 53% above the consensus estimate of $7.2 billion. And it also signifies a 64% year-on-year growth compared to the first quarter of last year. NVIDIA said that this growth will mainly be driven by the strong growth in data center business, which is benefiting from the steep demand increase in generative AI as well as large language models across its customer base as well. And the company also said that this demand increase has allowed it to extend its visibility of the segment's business over the few quarters, but although it didn't provide any guidance beyond the second quarter, it states that it will be procuring a significantly higher level of supply for second half of this year, where it expects sales to be higher than the first half as well. Gross margin is expected to be 68.6%, which signifies a 25% year-on-year expansion, or about 6.6% on adjusted basis. And this is because NVIDIA incurred a $1.2 billion inventory charge last year. We think that this gross margin expansion is mainly due to the company selling more of its new H100 data center GPUs, which we also believe cost as much as 200% more than its previous A100 GPUs. Yeah, for the negatives, however, the company's gaming and professional visualization sales continues to contract. So gaming and Provis sales were down by 38 and 52% year-on-year in the first quarter. But this decline, and this is because both segments continue to face macroeconomic challenges as well as lower sell-in to partners to normalize channel inventory. However, this sales decline has moderated compared to the year-on-year decline in the fourth quarter of last year, and it was actually up quarter-on-quarter because NVIDIA ramps up its new GPUs based on the Ada Lovelace architecture. Next slide. In terms of outlook, so NVIDIA's automotive business was up by 114% year-on-year for the first quarter of 2024, but it was up by only about 1% quarter-on-quarter to about $300 million. And this is about 4% of its total revenue. So the moderation in the quarter-on-quarter growth was mainly due to Chinese NEV makers adjusting their production schedule because there's a slower than expected demand growth. And NVIDIA said that it is expecting this trend to linger for the rest of the calendar year of 2023. However, it also said that its automotive design win pipeline for the next 6 years has expanded to $14 billion, which is up from the $11 billion that was first announced in March last year. In terms of the guidance, as I mentioned before, the second quarter revenue is expected to be $11 billion, which indicates a 64% year-on-year growth, with growth mainly coming from the data center segment. And the company is expecting an operating expense of about $2.7 billion for the quarter. Lastly, the management also indicated that the company estimates that there is $1 trillion worth of data center infrastructure worldwide, which is based on CPUs, and which means that they are unaccelerated. However, it also believes that generative AI will be the main workload of these data centers, which means that they will eventually need to migrate to the accelerated computing platform, which is the target market for NVIDIA's products. NVIDIA continues to be the leader in AI and in hardware and software provider in the field of AI. And this is because its GPUs have a superiority hardware performance, as it is equipped in in majority of the top 500 world supercomputers. And at the same time, NVIDIA was also the one who invented CUDA, which is the programming language that was the first one to allow developers to code directly onto the GPUs. And this programming language is widely adopted by developers worldwide. And this acts as a strong moat because it runs solely on NVIDIA's GPUs, and developers are unlikely to migrate to another platform, because this means that they need to make fundamental changes to their codes and risk of tampering with the functionality of the programs. And furthermore, NVIDIA also has a very strong customer base, including companies ranging from hyperscalers as well as enterprises, including companies like OpenAI, Microsoft Azure, AWS, Google Cloud, Oracle, and Meta. In terms of our valuation, we increased our revenue and PATMI by 30 and 52% to account for higher than expected growth in data center business, as well as lower than expected operating expenses. We increased our target price to $440 using a WACC assumption of 6.8% and terminal growth rate of 4.5%. And our rating downgrade is mainly due to the recent share price performance. So that's all for me for NVIDIA. Now I hand over my time to Glenn to talk about DBS. Thank you.
Thanks, Max. So for DBS, we recently attended their Investor Day last Monday, where the management shared their digital-led strategy in growth markets, and as well as how new businesses with potential have evolved from the previous Investor Day they held in 2017. So I'll just be going through some of the key takeaways from the Investor Day that we attended. So let's move on to the next slide. Yeah. So I think the key takeaway that we took from the Investor Day was regarding their group financials. The first point being that they have guided for a medium-term ROE of 15 to 17%, so medium-term being 3 to 5 years. And the uplift is coming from three things. The first one being faster growth in capital-light, high ROE businesses, which are such as wealth management, global transaction services, as well as treasury market sales. The second one being increasing their ROE with scale in growth markets, such as their transaction banking, wealth management, SME lending, and unsecured retail lending. And thirdly, is capital headroom to support profitable growth and higher distributions. So what all this means is they have mentioned that ordinary dividends will be lifted by 24 cents each year. So it has been lifted already 24 cents to $1.68 in 2023. And in 2024, which they mentioned that the baseline is that they will increase it by another 24 cents. So there is also another further upside of 3 billion based on their optimal CET1 operating range of 12.5 to 13.5%. Currently, in the first quarter, they reported that their CET1 is at 14.1%. And with this upside of 3 billion, what could be done is that it could be distributed into further ordinary dividend step-ups, so higher dividends, special dividends, like what we saw in the fourth quarter of 2022, and or share buyback. The second point we took away from their group financials were that their group ROE structurally improved by 250 basis points. So on the base total, the ROE improved by 380 basis points to 15% in 2022. And this improvement by 380 is from 2015 of 11.2%. And this 380 basis points came from 220 basis points uplift in external drivers, 250 basis points increase in structural drivers. And this total is offset slightly by a 90 basis points dip in financial leverage. So I think I'll just, the main point here being the structural drivers. Well, these structural drivers include extended superior deposit franchise to foreign currency, growth in their high ROE fee income, as well as new capabilities in credit risk management. Now, moving on to the next segment, it would be their transformation of management. They also mentioned how technology has sort of transformed the way they manage. And there are three key takeaways. The first one being technology capabilities. They said that they have started their transformation 9 years ago and have managed to transform it from a single rigid system to a nimbler tech stack. And they're also using a hybrid multi-cloud strategy with in-house infrastructure. And this actually manages them to lower their price point below that of AWS or Amazon Web Services. Secondly, they also have a new way of working, and they are now making it embedding their tech into management of teams where multifunctional teams work as one to deliver sort of a differentiated customer experiences. And they've also shifted from a vertical silo organization into a more horizontal one. And lastly, they have also put it into their credit risk management, and their new tech architecture have such as the unified platform, has allowed them to reduce their preparation time for credit application, and as well as the preparation time for financial analysis. And so this has increased the efficiency and effectiveness for credit risk management. But the last one is, they also briefly mentioned about how their tech has expanded to other parts of the bank, and this is mainly their consumer and SME, private banking, global transaction services, and treasury markets. Most of this, just to sum it up, what they said is that their artificial intelligence and machine learning, or AI ML, and their data collection have enabled access to new segments, and it has also increased their sort of response time and how fast they service their clients. So as such, we maintain our buy recommendation with an unchanged target price of $41.60, and our FY23 estimates remain unchanged. So that's all I have for DBS. I'll now hand it over to Darren. Thanks.
Thanks, Glenn. Yeah, so actually the next couple of slides are Phillip on the ground for Cordlife at Japan Food, but it's actually Peggy's slides. But Peggy's on leave, so I'll help to speak on her behalf for Cordlife and Japan Food. Yeah, so for Cordlife is a company that provides cord blood banking. It's a 6.8 million company market cap. So basically, their revenue it grew in first quarter 2023 after 4 years of decline. The drivers are more roadshows and the Hong Kong and China reopening, as well as Hong Kong new visa scheme. So for the Hong Kong new visa scheme, basically, Hong Kong, they relaxed their visa rules at the end of last year to get entry to Hong Kong. So people can get entry to Hong Kong even before finding a job. And another thing is that if you give birth in Hong Kong, you can get a Hong Kong citizenship. So that's why there's some demand there of people going to Hong Kong. And they also diagnostic and stem cell service, which gained a lot of traction in the first quarter of 2023. So the bright spot for them is this new PBSC, the peripheral blood stem cell service, which is a tie-up with the Center of Clinical Hematology to provide stem cell processing and storage services for the patients who require bone marrow stem cells as part of treatment for cancer as well as other disorders. So right now they are quite focused on this cord blood banking, which relies on a lot of babies and the high growth rate of high birth rate. So if the birth rate is slowing down and then they have less customers, so they need to diversify. So this is one of the bright spots for them. If this can take off, then it'll be really beneficial good for them. Yeah, and for cord blood banking, right now they face intense competition because there are 3 private cord blood banks and 1 public bank in Singapore, and of course the declining birth rate. So we also expect some recovery in the Hong Kong from mainland patients after the relaxation of the visa, and there's consistent growth in Indonesia and the Philippines. And right now they have a cash of 80 million, and they intend to use this 80 million cash for M&A. And right now they are trading at a net tangible asset of 41 cents per share. Yeah, next slide, please. Yeah, next is Japan Foods. So for Japan Food, is a restaurant operator. Some of their famous restaurants that they operate are Ajisen Ramen, Menya Musashi, and Afuri, to name a few. And so as you can see on the chart on the right, their revenue growth 43.8% on the strong recovery in restaurant spending, and the net profit also it kind of grew 27.7%, but if you don't include the JSS that they received last year. Last year they made a loss, so this year they didn't receive any GSS. So as a result, you can look at the net profit there. Even though they received GSS last year, it's still 27.7% growth. So they have 65 fully owned restaurants in Singapore and 17 under associates in Hong Kong, China. Some of the earnings tailwinds for Japan food is that the lifting of COVID restrictions where people can dine out more. And there are also 9 new stores in Singapore to generate more revenue in the second half of 2023. And they are trying to raise their share of halal stores. And for them, they also mentioned that stores at the suburban malls are performing better. And they are trying to raise their share of halal stores, and they're also trying to expand these halal stores into other countries as well, like to Indonesia. This halal concept. So right now for them, their cost is an issue. So labor in Singapore is a constraint for them, but they recently set up a new central kitchen to help elevate some of these limitations. Their rents that they sign, most of them are fixed, and generally in the market, the leases are 2 years, but they are willing to commit 3 years because they have the clout and the scale. So they committed 3 years at a muted annual reversion of about 3 to 5%. Yeah, so more owners are restraining. So 3 years, 3-year contract. Sorry. Yeah. Another thing is that they are able to pass on the additional costs. As you can see, the gross margin, the input cost, the gross margin year on year is flat at 84.6% on the chart on the right. So how they do this is that they do it subtly by like offering set meals to mask the price increases, so that it's not really very obvious to the customers when you add everything into the set meal and then you just increase slightly. So this is one of the strategies that they use to kind of pass on the high input cost to the customers. So for the outlook, the next year will be Japan Foods will benefit from tourism recovery, with more stores added, as well as the rebound in Hong Kong and China operations, with that term profitable in the most recent 2 months, especially since the lockdowns were there no more lockdowns in China. And some of the risks going forward for Japan Food is that the strong Singapore dollar will deter tourists from returning, as well as rising competition from all the other restaurants who are at the same price point, not only just Japanese restaurants. And their growth segment they think is halal, this halal segment where they also, like I mentioned before, they were trying to bring it to other countries. Yeah, so that's all for me. I'll now hand over the time to Zane. Thanks.
Thanks, Darren. I'll now move on to the technicals. So for looking at the S&P 500 last week, we actually saw a back test of the 4,130 level, which we actually broke out from, and we are currently back again at 4,000. So this has been a few times that we tested 4,002. If we continue on the current bullish momentum, we could see a retest of close to 4,320, which is the highest, the next swing high made in August of last year. As for the immediate support, is currently still at likely to remain the same at 4,050 to about 4,130. There has been some talk about lack of market breadth as we saw the big caps advance. So we actually look at this topic where is market breadth a lead indicator of the market direction. So actually, what is market breadth? So it's actually an internal indicator that helps investors look at the level of broad-based buying or selling that taking place in the market. And it primarily looks at the number of stocks that's going up compared to those that's going down. So when you talk about positive breadth, it actually means that more stocks are actually advancing than declining, which actually suggests the market's bullish momentum and confirms the price rise in the index. And then a negative breadth is actually the converse. Some breadth indicators also look at volume, as we believe that price moves on a larger volume actually more significant and more reliable. So the first breadth indicator that we can look at is actually this advanced decline line known as AD. So what it does is it actually detects the difference between the number of advancers and decliners, and then it adds the result to the previous value. So what AED will rise when there's actually more stocks that's advancing, and will fall when there's more stocks that's declining. So for the AED, when we see the comparison between the chart and S&P 500, you can see that when the AED reaches to a value about 96, we can see that usually the S&P will sort of come down from the a swing high, while when it reaches to a value about 94, close to 94, it will come up. So for this, is generally still you can see the correlation is generally still quite okay, except for there was this one time in October last year where we dipped below 94 before the market actually made the short-term bottom over here. And so for this, the AD is generally still an okay indicator to determine the tops and the short-term peaks and the troughs for the S&P 500. But it's still more coincidental than a leading indicator. Then next indicator we look at is this new highs and lows index. So as the name suggests, what it does is it actually shows the daily difference between number of stocks reaching new 52-week highs and those reaching new 52-week lows. So if the number is actually positive, it actually shows that more stocks are actually making new highs. And then if it's negative, then it's the reverse. But for this indicator, it's actually a bit less reliable. When you look at the comparison between S&P 500 and this chart. So in last year, when the market was actually quite down, we actually saw the new high to lows index actually made a very low levels over here. We actually see levels such as -100 before the market actually start to bounce from the bottom. But in this year, we actually saw the market actually recovered from a swing low when the indicator was near to -50 on the chart. So for this breadth indicator, it's actually less reliable to actually sort of even predict the short-term highs and the bottoms, let alone be a leading indicator for the market direction. And then last indicator I'll talk about is this McClellan Volume Summation Index. So for this, is actually an oscillator that measures the breadth by analyzing the cumulative volume of advances and decliners. We take a difference between their two exponential MAs. So this is generally is still a better indicator as compared to the new highs to lows index, in a way that it functions a little bit similar to the AD as mentioned in the first indicator. So when you see that when the value actually reaches close to about 1,000, that sort of usually marks the swing high in the index. However, the limitation of this is that when we use it to actually try to determine the lows for the index, we see that actually makes the lows at different points can be minus 1,500 to about close to about minus 4,000. There's no fixed value to determine the lows. So for this is still quite a poor indicator to actually sort of determine the market direction as well. So in conclusion, with S&P 500 being a free float capitalization weighted index, where the large caps actually carry the most weight, we could see that the large cap may actually drag the index higher when actually most of the stocks in S&P 500 could be falling this year. So that actually leads to the divergence we have seen between market performance and breadth. Since that market breadth is mainly focused on analyzing the number of stocks going up and down. Hence, market breadth is actually unable to predict the overall market going forward, and actually serves more of a coincidental indicator than a leading one. Yeah. Then moving on to the technicals for individual stocks. The first one I have is NEO. So for NEO is a technical buy at 879, take profits at 1070 and stop loss at 770. The stop loss goes at 770. So this trade was actually invalidated as it hit the stop loss. So for this, the original trade idea was that there was a breakout of this downtrend resistance line over here. And this was after we saw that when the price made a lower low and subsequently recovered, and there was a sideways direction and started to pick up some momentum here. And there was some bullish divergence observed in the RSI as well as MACD. So with that, we thought that the price could possible to hit 1070, which is about the 50% Fibonacci retracement level as well as a recent swing high in April this year. Yeah. Then the next one will be Best World International. So for this, it's a technical buy at 184, take profit at 201 and 214 with the stop loss at 180. So for this, stop loss closed at 183 on Friday. For Best World, there was a retest of a previous horizontal resistance, now turned support. So this was a previous resistance. The 182 level was a previous resistance back in December to January. We actually saw a retest as well as coupled with a retest of this downtrend channel support over here. And then we look at MACD and RSI, there's also bullish divergence coming in, showing there's a possible pick up in terms of bullish momentum to possibly, if we do break out of this downtrend channel over here, then we could possibly retest 201, which is a recent swing high, followed by 214, which was a previous support level that we actually broke down off. So that's all from me today. I will now pass on my time to Paul to talk about LHN results.
Thanks, Zin. So I'll move on to LHN results, growth from new capacities. So the message here is that we think the second half in 2024, we expect strong growth because of new capacity, which we'll discuss later. Next slide. So for LHN's results, first half, it was within our expectations. You'll notice that when we look at the profit itself, it's actually down 10%. You look on the table on the left, the adjusted PATMI. That's mainly because of the absence of a DOM business. So in last year, they had this DOM business that ended in June. So this is more like a one-off contract where because of the pandemic, they were managing some DOMs on a contractual basis, not buying any property, just pure management of DOMs last year during the pandemic. And when the contract ended, so you see this drop off in earnings for them. The positives for us is the growth in co-living and car park. So just to remind everyone, so co-living is between a hotel and a service apartment. The difference is that it is 6 days. So, you know, hotel is 1 day, then service apartment usually take 1 month. So it fits between a hotel and a service apartment. Why it's doing well is because it will benefit from the rental market, because you know, those who want to rent, they get the higher, because the rental market is so buoyant. So people will shift to co-living. They can rent for 3,000 for few months rather than a room, or whereas if you know you will book, if you want to rent an apartment, you probably have to sign a 2-year contract. Where this one you can sign 6 days to 3 months to 6 months, so there's flexibility. And co-living also benefits from strong hotel revenue, which is also a bit surprise for us. But what's happening is that online OTAs, you know, like Booking.com, Agoda, will also allow you to book a co-living space, but on a minimum of 6 days. And that is still cheaper because on average it's about $150 a day, and this is like fully furnished and so forth, with even washing machine inside. So for us, the positives that you look on the table on the left, there's a huge growth in the co-living, 50%, and car park about almost 30%, and that's 40% of the revenue. So co-living did well because of the new capacity in Lavender, and car park did well because it's reopening. So the car park business is that they'll tender for some public and some private car parks, and then they will just take on the volume risk. So that's how the business model works. In terms of the negatives, it's not, you can't see it on the left hand side, but there was higher interest expense. It went from 2 million to 4 million, but nearly that, it was mainly because they were acquiring new properties for the co-living. And there are ways for them to deleverage if they want to, because they have like several properties, where industrial properties, where if they wish they could sell it off, and also kind of to de-gear as they shift more towards co-living. So if you look at the outlook, so for us the outlook would also be strong because they're going to get the full RAM of 500 keys. So right now they have about 1,000 keys, 1,600. So this is like 30% all new. And the big one is the co-living Orchard. Is just behind Mount Elizabeth. They're just behind Lucky Plaza. So this property is 411 keys, and that you get the full benefit for the next 12 months because it only turned on in kind of March. So you get the boost in revenue from that. You also get the boost in car parks. So their car parks will expand another 2,000 to 21,500 car parks in Singapore. Car park lots are not car parks. Car park lots because they tendered for this the Defu Lane new industrial which is built by JTC. So both of these should contribute to revenue growth in second half 23. Then for 2024, they will have a new ISO depot. It's also very difficult for me to understand ISO depot, but ISO depot means there's those stuff chemical containers that usually they will ship from chemical facilities in Jurong for export. And what happens is that these chemicals need to be clean, need to be stored, and then they have this new depot that will service this. This is under their Lisco LHN Logistics. Then another source of revenue growth or profit growth will be the food factory. So food factory is like a central kitchen. The reason why it's doing well because there's a shortage of this, because you need zoning laws to be able to start up a food factory. So that should generate almost 60 million revenue, but that's not recurrent. So that's like a strata title sales. Then there's another 276 keys in development. So all this should support earnings for 2024. September, their year end is September. So for us, we didn't move our numbers. Earnings target price all unchanged, and they are paying like a dividend yield of probably around 7%, depending on share price. Because you can see the table on the left, they raised their dividends by by almost 70%. If you round it off to 1 cent, then if you analyze, they should pay around 2 cents. Because last year final they also paid 1 cent, so it should be 2 cents. At least we are forecasting. Next slide. So I'll move on to Singtel results. So as the name suggests, put down under is Australia. So Australia was pulling down the results. Next slide. So for Singtel, revenue, the revenue was in line with expectations. EBITDA was slightly off because EBITDA, if you look at the table on the left here, is the Singapore, is mainly because Optus was weak Australia, and also there was a 7% depreciation in the Australian dollar. So that also hurt the profit and also revenue. So the positives for us, for Singtel, is the mobile business. So you look on the left, the EBITDA, the Singapore consumer, you can see there's a 15% jump. So that benefited because of reopening and the roaming revenue. And you can see from the revenue side, the ARPU is up 9%. So that is a help, that kind of boosted because of roaming revenue is pure profit business. So when the borders open, subscribers can either outbound or inbound, but I guess for Singapore, it's more outbound. Then the other part is the continued strength in Bharti, which is their Bharti Airtel, which is their Indian associate mobile operator. You can see on the table on the left or at the bottom, Bharti, you can see there's a 44% jump in earnings. But for Bharti, it's mainly both pricing and also subscribers, the 4G subscribers. The negative continues to be Australia. So for Singtel, they are trying to target return on investment capital, which is ROIC. Is basically that's profit divided by all the capital, debt, and so forth, rather than just stick on equity. They're targeting double digit, which I'm not sure how they're going to do it for Optus because it's only 2% return. And this is even after Optus spent almost 4.5 billion of capex. I think maybe put in savings account probably might make more money. But anyway, the second half Optus only makes 7 million. So this is like, I don't know, less profit than some small caps on it. But so in terms of the outlook, so we think for Singtel, what can drive the share price is going to be capital management. I guess this is a common theme between all the GLCs or domestic link companies. So for them, they're going to look to recycle, I guess, do the capital cop thingy. So they're going to recycle almost 6 billion of assets. They're not so explicit like what is it, but in general, they're going to dispose of Trustwave. There was, I think, losing, maybe 70, 80 million EBITDA, if I'm not mistaken. Because so this Trustwave is a loss-making business which they want to dispose. They're also going to redevelop, Comcentre, behind Somerset. They're going to redevelop and sell part of it. So this is part of the recycling. And also infrastructure assets. So that is more interesting because they have submarine cables, they have data centers which they could combine it up and then do the usual, sell a small stake and then get some profits that they can recycle. Recycle means basically sell. So sell some of the assets and monetize some of it. The growth for them will just come from mobile ARPU, which is selling price ARPU, we call it average revenue per user. So that is basically coming from Singapore because of the rebound. India to a certain extent, although our pricing is slowing down. And the other two business which they did, NCS and digital infrastructure. So NCS was always hidden inside Singtel. I mean, they don't actually separate it. But I think 2 years ago, they separated NCS so that they want to, I guess, eventually do some listing eventually, but separate it and make it into a separate business. And let it grow on its own. So they want to do more IT services. But all these are in investment stage because they have to go, because you want to sell IT services regionally using a Singapore expenses. I don't think it will work. So they want to build up in India. They are expanding their headcount in India and also in Vietnam for the IT headcount so that they can service at the lower cost base. The other thing they want to build is digital infrastructure, which is like we mentioned, which is mainly there are data centers, but the meaningful one will only come, we think, in FY25 because most of the data centers, I think they have 2 or 3 large ones that were turned on where they will generate revenue only in FY25. For us, we got no change in our revenue EBITDA or target price. Next slide. So I'll just run through the usual weekly updates. So for Singapore, we have industrial production, basically manufacturing activity. So that is still weak. It's still trending down. Electronics is also still weak. You can see from the first bullet point. We had our inflation number. It is above the MES target. So I mean, I'm not sure. I mean, if it continues to be this high by June, then there might be a chance, MES might want to kind of appreciate the Sing dollar even more. Again, this is all speculative because depending where core inflation. But right now, 5% is definitely above their so-called 3.5 to 4.5 range, and they target core inflation to end by 2.5 by end 2023. So okay, definitely not hitting that trajectory, but there's risk. I mean, it doesn't meet that. There was some wage data if you're interested. So there's this CPF. They based on contribution to CPF. They actually measure how is wages in Singapore. So that's doing well, roughly about 6% first quarter 23. And of course, this will help domestic spending in Singapore. Not to mention property that we recently saw. Then our FDI is also strong in Singapore, although it came off from the 37 billion in first quarter, but these are still very elevated levels for Singapore. So we are attracting a lot of FDI. Pre-pandemic, you're looking at maybe 20, 22, 23 billion per quarter. So 30 billion is still a huge number, just that in 2022 was exceptionally high. Okay, we also have this German, GR means Germany. I mean, again, we are not European experts, but we just that they entered into a technical recession. But the funny thing is that their stock market actually hit all-time high. But of course, their market includes total return, which is dividends. So this is just to give you a sense that even if the US does enter into a recession, this is going to be a bit kind of different type of recession because if you use Germany as an example, their unemployment is actually record low. Probably like, I don't know, 30, 40-year low in unemployment. But the key thing is their nominal GDP is 6%. So nominal GDP means, it's basically cash flow. It's based on current value. Just that, when for economists, they always take out the inflation, then you measure real GDP. So although we might have some technical recession in the US, if it follows like Germany, you might have very low unemployment and then nominal GDP might actually still be high. That means there's not much stress on cash flow because the economy is still growing at 6%, but without stripping out inflation. So, I mean, that's why we brought up this Germany recession. In the US, we got this bad data because the inflation, not surprising, but inflation is still very stubbornly high. Mainly because of services. Then what is happening is that if you just kind of extrapolate this number, we're probably going to hit only 4.7% inflation by December, which is below the Fed expectation. So every 6 months, the Fed will give a forecast. The latest forecast is that they think it's going to 3.5. So this is way off. Not to mention their target of 2%. So as a result of this stubborn inflation reading, I think the market is now pricing in a 25 basis point hike for June. We don't think so, but our track record on this isn't very good. But the market is now pricing in a rate hike of 14 June. Next slide. So in terms of technical views, I mean, like what Max talked about on NVIDIA, just that we don't think there's going to be a turnaround in semiconductor for SGX-based companies. So this is going to be very unique for NVIDIA. So the reason why we think so is that we think it will be more a reallocation. So the huge surge in orders for NVIDIA came from their data center GPU. That means they're going to put more GPUs or graphic processing units into the data centers rather than CPUs. So we think it could be more of a shift in demand, and cloud isn't going to be expanded. So it doesn't mean the whole semiconductor sector is going to do well, maybe more unique to NVIDIA. But one thing that might happen is that because when you use GPU, there's a huge power demand. So there might be some demand increase for data centers. I mean, we're not very sure how it's going to affect some of the data center REITs, because most of their portfolio is all triple net. That means power doesn't increase in power doesn't really boost their revenue. But this is one phenomenon that will happen. So what we think is semiconductor demand is still weak, although sentiment is strong, but we don't think on the ground the demand actually changed much. Again, market is now pricing in, like we mentioned, of a rate hike. And this isn't good because if there is another rate hike, it will only make any downturn in the US sharper, number one, and it also kind of worsen the credit and liquidity conditions in the US, because the liquidity is flowing out from deposits and so forth. And this may not be the typical recession to fear, because if you use Germany as example, the headline may be recession, but on the ground, the earnings and also unemployment rates may not be that weak. So inflation will kind of cap the downside in earnings. For some of the events, we missed here, but actually there's also a BHG read for a webinar we have coming up this week. We also have the key event to watch will be 2nd of June, the US jobs data on Friday. Next slide. So move on to some of the slides. So you can see manufacturing activity in Singapore is still weak. Continues to slide down based on the blue and red chart. FDI in Singapore is strong, so that's very good data point for Singapore. If you look at our FDI, 2021, 2022 took a really sharp record level jump. The problem is, of course, we don't have details on this. This is just they just give this kind of huge data and not much details in it. Next slide. Then you can see from here, so this is the Fed's, whenever the Fed talks about their inflation target of 2%, you're referring to this data point, they call it the PCE. So if you extrapolate it, it is not going down. You can see from the red line, which is 2%, it's nowhere near 2%. So that's the worry that most likely there might be another rate hike, and the market is starting to price. So this is interest rate expectations. This is how the futures market is pricing interest rates. So by June 23, or July, you're looking at maybe 18 basis points, but maybe more like a 25 basis point hike. The market is starting to price by 14th of June. Next slide. Okay, so this just to give you a flavor. This is our cloud capex proxy. So this is what this is generally the broad capex of the hyperscalers. So hyperscalers are guys like Amazon, Microsoft, or Facebook. These are the ones, the biggest spender. Hyperscalers is another, I don't know, fancy word for the biggest spenders in data center. So you can see that in the last 3 years when the pandemic happened, they more than doubled their spending from maybe 70, 80 billion to almost 140 billion. But right now you're looking at just flat capex coming up from the hyperscalers as a proxy. Next slide. So my last will be just on Yoma. So Yoma had an analyst briefing. So for those who are not familiar, so Yoma is a pure Myanmar-based company. They are involved in property development, KFC franchise, and also a bit unique. They have this fintech business, Wave Money, which is basically to transfer money. So if you want to transfer money from I don't know, the city to some shop, some urban center outside city, the person will just walk into some of those merchants, which were like telco merchants that sell prepaid cards. Those small shops, they go there, give the money to them, then transfer to another shop, which be somewhere outside in the rural area. Then from there, they will collect the person who's going to receive or collect the money there. So they're actually using all these small shops to transfer money. So for them, they continue to lose money, but most of it came from the impairment from Yoma Central. So Yoma Central has been the biggest overhang for them. So Yoma Central was a huge project supposed to be in Yangon, and that was supposed to be I don't know, probably like $100 million project to attract foreign investors to come in. But of course, when the coup happened in February, all this was discarded. So they are slowly starting to unwind this project and then redevelop it to focus on local. I guess the most positive for us, the most important metric was the net debt. So they managed to bring down their net debt by almost 100 million US to 160 million. And considering they are earning revenue in their local Czech currency, so this was quite an achievement. What they did was they sold the bank, one of their properties, to the Yoma Bank. They managed to sell en bloc some apartments, and I guess the most amazing thing was they managed to get Mitsubishi to inject equity into the Yoma Central project, almost 54 million. So this was a project that also had Mitsubishi as a joint venture. So as a result of this, they managed to delever almost 100 million of debt. The other thing is that property continues to do well. They have like almost 34 million of unrecognized revenue. So one of the reasons property is doing well is, apart from the good infrastructure they have, is they act as a hedge. So what's happening in Myanmar is that they stopped publishing inflation numbers since the middle of last year, but apparently inflation in Myanmar is around 40%. So as a result, a lot of people are buying property as a way to hedge out against the high inflation. Then also Wave Money is doing well because I think they started to provide more liquidity for all these agents so that they can allow these money transfers to happen. And I think I'll leave it as that. I won't go through too much because the purging of unverified SIM card, what happened was that when the coup happened, there was a lot of SIM cards there, the identity wasn't known. They had to kind of shut that down. And of course, that affected the Wave Money business because this money are all usually transferred by handphones. Then F&B is doing well. F&B is mainly KFC, so they are increasing price almost 3 times this year, 5 to 10%, and they are achieving record revenues. But is it time to get back in? The macro situation is still uncertain. I mean, because they are still affected by a high inflation and a weak currency. And the politics is still uncertain until and unless you see maybe some elections happening, then maybe there is a chance that politics there become more stabilized. Okay, with that, I think we can move on to Q&A. Yeah. Thanks. You're on mute.
Okay, okay, I think I can begin on the Q&A since there's a question on PA. Let me share my chart right now. So the first one is Maple Tree Pan Asia Commercial Trust. Okay, so for this, recently there's been like a breakdown of this uptrend channel over here. But actually price, you can see, started to sideways a little bit from the recent downwards movement over here. So the next support level we can probably look at for now is close to about 160 to 161, which was the recent swing low in the middle of March over here. If price continues to fall over here, while the current resistance, I think, is likely to be close to 170 around here. Okay, then for BRC, I think recently there's been a sort of a rebound for now, but we are still in this downtrend over here. So for now, we actually retested around 167, which was this previous support, currently turned resistance over here. So for now, we see a little bit of a pullback, while I think support, for now, the current support is close to about 160 to 161 over here, which was this level that we actually broke through and stayed above over here. So over here, this will be a first support level. The second support level will probably be a retest of the close to the 156 swing lows, which might be confluent with this bigger uptrend channel support over here, if we actually come down to these levels. Okay, Beijing Jingnan Clean Energy. Let me see the chart for this. I think currently you can see the chart is actually quite range bound for now. So you can see the support is close to about 185 over here. The resistance is still at 2. I think for now, we might see price probably trade in this range since we haven't actually retested the lows. If we do see a retest, I think that might hold and we just continue to trade in this region over here. Okay, then next one will be LHN. Okay, so for LHN, we actually had a very big rise. This was after we actually broke out of this downtrend resistance line at 29 cents. Then we cleared a few resistance levels, such as the swing high at 35 cents and also 36.5 cents. And there was a resistance close to over here at around 39 cents level. We actually we fell a bit short. We hit 38.5 cents, and looks like they're starting to see a little bit of a weakness over here, given the high volume, and we actually seeing a little bit of pullback. So price might actually consolidate for now. I think support could be from close to for now, probably be around 34 cents to about 35 cents over here for the current support. My next one is HST, this Lion OCBC Hang Seng Tech. So for now, it's a little bit bearish since we actually breached the 63 cents level over here. This was after multiple tests of the support. If you're unable to recover back above, then that will confirm the recent bearish movement taking place over here. Then the next support level might be close to 59.5 cents to about 60 cents level, which is this. There was a previous swing high resistance that acted as support over here, and also it coincides with the 61.8% retracement level. So this might be the next support level to look out for in this current downtrend for the Hang Seng Tech. The next one is Keppel Pacific. So for this, we're actually still quite weak. You can see the downtrend over here is pretty strong. Then actually broke below 34 cents and 35.5 cents, this support region over here. Then recently price we did a retest over here. So for now, there's still probably resistance around this previous support term resistance. Yeah, then I think for now, probably the downtrend might actually still continue. Then there's also this possibility of this trendline resistance that's acting on it over here, being a double resistance area. The next one, venture. Okay, for venture, I think currently price is seeing a little bit of support near the $15 level, given that we actually retested the swing low over here, which was in March last year. And over here is actually seen MACD, we had positive crossover recently. So we could see a little bit of rebound taking place. Resistance wise, I think we probably will range from close maybe about $15.70 onwards to about $16. So this $15.70 was this previous supports in the past in April, July last year, and it was previous resistance in October also. Then the higher level of support previously was $16, but now it's resistance as well for venture. The next is AEM as well as UMS. Okay, some of the other tech names. And for AEM, we actually retested this recent swing high around 373 today. Then we saw a little bit of selling take place. So for now, that could be a short-term resistance. The other resistance upwards will probably from about 380 to about 390 over here. This swing high generated in November to December last year. Yeah, so for now, there could be some resistance in the near term for AEM. Then for UMS, I think for UMS, we actually did a rebound after we over here. So we have found support from this trend line support over here. Then we actually managed to cross above 99 cents. This was a previous support. Term resistance, we managed to break through it as well as this downtrend resistance line. So currently we are testing the next resistance level close to about 110 over here. Over here, there might be some resistance. 110 to about 114 will be this resistance zone over here for UMS. And then next, First Resources. Okay, First Resources looks not bad for now. So we actually managed to clear this 150. It's quite a strong resistance level over here. So we do find, as long as this level is supported, I think we could head to test this swing high close to 160 over here. Okay, then for Franken, we also a bit similar to UMS. We found support upon this trend line support over here. So it's bounced, and for now, I would say that the first resistance level to look out for is around about 88 cents over here. Previous support. The next level to look out for probably be closer to 93 cents, also a previous support. Then also we can use this trend line resistance over here as a reference. So in this zone, we probably expect some short-term resistance from this downtrend bounce. The next one would be ARA Hospitality Trust. Okay. It looks like for this chart, it looks it's a downtrend, but we're currently looking like a range. So in this stretch, it looks a bit similar to this stretch over here. So I'll expect some range trading take place since we are still finding support around the 33 cents to 34 cents mark. Then the first resistance level could be close to the short-term swing highs near 36.5 cents over here. So that will be the short-term resistance for ARA Hospitality. Okay, then for Prime, I think Prime for now we could be encountering we have actually met this resistance line over here, this downtrend resistance line. We did a retest. We're also close to the 25. We actually hit the 25 cents. This previous support and turn resistance over here. So I will be expecting some sort of pullback for now, which is actually taking place. We see whether this 21 cents level which actually broke out from can hold as a support in the near term. If not, we might continue with the downtrend over here. And for the Manulife, for Manulife, we actually broke through this downtrend resistance line on Tuesday last week. Then we did a retest of this this trend line resistance over here. Saw a little bit of pullback. Currently, we just sideways trading over here. So for now, I think the support level will probably be this 14.9 cents level, this horizontal level we broke out from if we were to do a retest. Yeah. So as long as this level can hold, I think the share price might still do a short-term rebound over here for Manulife. And then next one for Yangzijiang. Yangzijiang, I think for now, share price is just sideways movement. This previous resistance around this previous resistance around 122 to 123 would likely act as a short-term support for now. Resistance will probably be still at 129 to 130. So I expect this range trade to actually continue for now. Then SEM Industries. SEM Industries is still very strong. We're still trading above this trend line resistance. So that indicates that the share price is still very strong. And also we actually broke through this horizontal resistance at 493. So we could still definitely hit higher for this strong stock over here. Okay, for micro mechanics, I think it's still bearish. We recently did a retest of this trend line over here. So looks like we're seeing a rejection at 197. This also was a previous support over here. So for now, share price looks like it's consolidating for now. That might continue sideways for now. But if we do encounter these levels, this level again, probably will see resistance again for micro mechanics. Okay, then for Capital DC, I think we are, after this stretch of pullback, we are finding some rebound from support at these 203, 204 level, which is this uptrend channel support. So for now, we are bouncing again. Short-term first level of resistance might be this 211, 212 horizontal level over here. Then followed by this level we broke from, which is around 215 to 216 for now. But the main, you can see that this mid to long-term uptrend over here is still intact, since we are still holding at this main uptrend channel support over here. Okay, next will be some Hong Kong counters. Okay, we actually booked, looks like it's bearish for now. We actually booked through 375 over here. So the next support level to look at probably be at 350, this 61% retracement level. Then this is also a previous resistance and support zone as well over here. So a bit similar to the HST as well. And next will be Tencent. Tencent for now looks bearish. We actually retested this support level again, around 320 to about 330. If we can't hold this swing low over here, we might see a low go a little bit down lower to possibly test this channel support around 305, 300 to 305 over here. Then this will be also the 50% retracement level, as well as a previous horizontal resistance over here. So there is possibility that the share price might actually dip a little bit lower to try to find these supports over here. Okay, then for JD, bearish, we actually made a new low over here. This was on Thursday. We actually broke through this 132, 183 level. So with that, I think with the new lows, share price might actually there's a chance that it could go lower. I can't give you a target for now since it's a new low, but if you do test this trend line support over here, which has held a few times, there's a chance that the share price might hit to maybe close to 117, 118 over here if it does retest this line. Yeah. And next one would be Ping An Insurance. So for Ping An, I think for now we are still trading in this downtrend channel over here. And then also bearish for now since we actually broke down from this wedge support at $54. So for now, that I think we could be retesting this strong support near $50 for now. We could be seeing some support over here since it was a recent swing low over here. Okay, then I'll talk about the three local banks first before I hand over my time back to my colleagues to answer some of the other fundamental questions. Okay, so for DBS, last week I said that we could have a short-term rebound since we find support at $30.50 and we broke above this resistance line over here. We did have a bounce over here and we are entering into this short-term resistance zone between $31.50 to $32. So over here, I think we could find some resistance closer to $32 for now over here. Then we might maybe do a range trade if that happens. Okay, next up will be UOB. For UOB, we actually broke through this downtrend resistance line as well on Thursday last week. Then we retested a recent swing high resistance at 28.40 over here. So we might have some resistance coming in at this level for now. The next resistance level will probably be around 28 for UOB. Then for OCBC, we are still in this range over here. You can see it's still bouncing from the support near 12.10. So I think that will continue. Resistance will still likely be the same, close to 12.40 to about 12.50 over here. Yeah, so I think we'll still continue in this range over here. Okay, so I think now I just hand over my time to my colleagues to answer some fundamental questions.
John, can you try the EV on thing?
Yeah. Let me take the question. Right. So there's a question here. Please comment on the EV market and other than Tesla, which are some of the good EV stocks we should be looking at. So we don't actually cover the EV market, but I can give it a go. Overall, actually the EV market is quite resilient. It's remained relatively healthy. There's quite a lot of demand. Speaking, mainly from Tesla's point of view, there's a lot more demand than supply. So, and this I guess goes for the overall EV industry. There's a lot more. What's constraining the growth is actually supply. They're given that they're quite a young industry, they're actually ramping up a lot of its factories, which take time to reach maximum output. But overall, given that there's a lot of tailwinds in terms of government regulation for electrification, there's quite a number of governments that have mandated basically the eradication of ICE vehicles by 2040 or 2050, which is I guess only like 20, 30 years away. It's quite soon. So this really provides a lot of the tailwinds for the overall EV industry. When you look at some of the other good EV stocks, I think the only one that can really come to mind is BYD. They're the main player in the China EV space. I believe they have about 25% market share right now. When you look at some of the other stocks that are listed on in the US, I guess like Lucid and Rivian, I think they're a little bit more of like niche products. And as of right now, they don't really have the scale of like Tesla or like a BYD. So yeah, I mean, there's not really that much else to comment other than significant tailwinds for the EV market moving forward. Yeah. Hope that helps. Thank you.
Okay, thanks. Let me just try to answer some. Any impact on the local stock market from US debt ceiling talks? We don't think that there'll be much impact. Firstly, of course, the first point is that do note that 5th June is the X date, not X-Men, X date set by Janet Yellen, that this is the time where they will run out of money. But essentially, even if we hit the 5th June, there is usually some reallocation because they can still continue pay interest expense on the debt, just that they just have to cut back spending on the rest. So this X date is not really an X date, it's probably a slipping X date. The second thing is that they've extended the ceiling almost 78 times since 1960. So I mean, we not gonna call and say the 79th time this won't happen. So we think that this thing would eventually get resolved, but regardless of the situation, it can only be negative, because to resolve it, they need to do some cutback in spending to appease the Republican side. So they need to cut back. Of course, even that also might be of some modest impact to the GDP, but we think it is going to be a lot of publicity or headlines, but we doubt it's going to impact the market. And even then, they could actually still pay the interest, because what has happened is that the debt that so-called might be defaulted, actually the Fed can actually buy it back. There's nothing to stop them, although it's technically not really right, but I think the Fed could actually come in and just buy back those debt and basically do purchase those debt that's coming due. There's also one avenue that can be. It's another way that they could bypass this rule. There are many other funny ways, but our base case is that this will be extended. Even if there is some sort of default, I think probably there's probably a good opportunity to go and it causes the local market to drop. Now, of course, I think it's definitely a good opportunity to come in and buy, because there's no way they can default as your own currency. Yeah, it's like seeing whether Singapore default on Sing dollar loans. No, right? Because it's our own currency. So if they actually do default and the headline is bad, then it's definitely a good time to come into the market. But for us, how we calculate is there is asymmetric downside. What I mean is, even if they do extend it, the market may not move much. But if this thing all worst case scenario happens, there's a lot more downside than upside. That's why we call it asymmetric, right? So there's more downside than upside for this particular event. So that's why we're a bit more cautious on the market for this. But if it does happen, maybe it's a good buying opportunity. Definitely a good buying opportunity. Okay. For Sembcorp and Keppel Corp, we don't have. Oh yeah. Okay. We don't have. Peggy is not. She's on leave. So. Sorry, we don't have any latest update for that. We have to wait for her because not too familiar myself to give the latest update. Alibaba, please share what you know about the restructuring and holders. Yeah, so sorry, we don't cover Hong Kong. Hong Kong is covered by our Hong Kong research team. So that's why we don't try to answer on their behalf for Hong Kong stocks. Hi, looking for some Thai exposure. What are the key considerations in investing in Thai SDR? Will it be more complex compared to direct investment? Okay, so as you know, there's going to be a launch, I think by tomorrow, maybe Tuesday. Yeah, I think it's tomorrow. The SDR launch. So in Thailand, you normally buy NVDRs as a foreigner. Yeah, I think even locals will buy NVDR because that's where all the volume is. So an NVDR, there's no voting rights, but it's traded like any other stock. So what is happening is that instead of trading these NVDRs for foreigners, actually most of the volume is NVDR, but anyway, these NVDRs are being brought to Singapore to be traded, and there are mainly three stocks: Airports of Thailand, PTT, and I think CP. So what's the benefit? I think in a nutshell, it's just convenience, because these are going to be traded in Singapore dollar and the brokerage might be lower. But what you trade off with this convenience is whether the liquidity is whether there's enough liquidity in Singapore. And these things are fungible. not immediate, but I think there's a few days of fungibility. But you just trade it because it's Sing dollar denominated and maybe lower currency. As much as that convenience factor. But the worry is just whether there's enough liquidity here compared to what's happening in Thailand. Yeah. Raffles Medical, what's your target price? Yeah, our target price is 176. Our FA target price. Please comment on Wilmar. So our outlook for Wilmar, I think, is going to be soft. If you recall, second quarter of last year was exceptionally good in earnings because I think, like we highlighted before, what happened last year is that if you dial back 12 months ago, when palm oil prices were surging, Indonesia had a ban on CPO exports. As a result of that, it actually benefited. There was some what Wilmar did was actually Wilmar stocked up a lot of cheap CPO, and then when the export quotas were lifted, they benefit from the low price and then they could export it much higher. So I think second quarter year on year, you're going to probably see quite a big dip in earnings. It might get better in the fourth quarter, but ultimately it all depends on the recovery in the Chinese consumer. So for Wilmar, the other main business, so they got plantations and plantation refinery, soybean crushing, and then consumer in China, the edible oil. So the only upside is when the rebound in consumer, because even soybean crushing is actually is still weak. It's not as big as last quarter, but I think they are probably more like breaking even rather than loss making. So the outlook for this year is going to be soft. It all depends on China. And also palm oil price after hitting 6,000, I think it's only trading now 3,000. So you're going to get the downside from that too. The problem for soft commodities now is because of inflation, and most of these products are sold in emerging markets like Indonesia, India, China, and because of high inflation, there's a bit more cutback in this kind of edible oils. So as a result of that, this year is going to be weak for Wilmar until maybe the fourth quarter. You might, if the consumer spending in China improves, so that they can benefit on their YKK side. So it's going to be weak. I mean, sorry to talk so long, but the nutshell is just going to be weak. Okay. Darren, you want to try on the Parkway one and also CDL? Thanks. I think you're muted. Can't hear you.
Sorry. Yeah. Well, we expect Parkway REIT to grow. We do expect Parkway REIT to grow and have better dividends with Japan yen improving. Yeah. So from what I saw, the most recent Japan yen is actually depreciated quite a lot. Like versus the Sing dollar. So now it's like 103, was 104 over the weekend. So I'm not quite sure what I mean by Japan yen improving, but this will continue to affect the income that they receive from the nursing homes. So do you expect the REIT to grow and have better dividends? I would expect it to be rather flat. Yeah, but right now there are a lot of recent potential acquisitions in Japan. Like Maple-Tree Industrial also just came out with an announcement last week that they want to acquire industrial property in Japan. Yeah, because the interest rates there are still quite low, around 1% or lower, and yeah, the cap rates still relatively stable. Might have compressed a little bit, but still relatively stable in general. Yeah, so that's one. Yeah, we do not cover Parkway Life REIT. Yeah, so for CDL, we are looking to reinitiate the coverage within the next few weeks. But for CDL, generally, we see a lot of headwinds for them because of the high residential prices. And for all these private, we think that the private residential prices, they are elevated because of the elevated public housing prices and the high rental growth. And yeah, we also foresee, because of all these because of the high prices, that there may be even more cooling measures that are to come on top of the recent ones already announced. So yeah, we are altogether in just a quick overview. We are not too bullish actually on CDL for now. Yeah, but their share price has corrected quite a bit, and they're actually at about 50 at more than 50% discount to RNAV. Yeah, more updates to come when we reinitiate coverage for CDL.
Yeah, but in general, I think the for Singapore property, because of the 70%, there was a launch recently, reserve residence in Bukit Timah. That was like, I don't know, 70% sold out. So that kind of boosted sentiment for property stocks at least. Yeah, that's why you see like Propnex and all that. And this is huge because they launched I think 700 units and 70% sold. So despite I don't know how many rounds, I think 17 rounds of cooling measures or so forth, the property market is still rising. So the psychology has kind of it's still very positive, at least sentiment for buyers. Okay, let me just,
sorry, I think that's all from.
Okay, thanks. Let me just move on for some more for. Okay, Paul, for Singtel, what do you think the impact of their recycling efforts will be on share price performance short term or in long term? I think you alluded that a lot of what Capital is doing. Are they similar? I think they are similar. Okay, so for the 6 billion, the difference is that almost maybe 4 billion or so, they're going to reinvest it into 5G and the other businesses. So I don't think the impact will be as drastic as Capital, because Capital was a bit more unique because they managed to sell off a huge I mean they sold off Keppel Offshore Marina, which is a huge loss-making business. So that was the big re-rating. Singtel doesn't have that as much as that. It's more like a Keppel mini-me, a very technical term here, but it's more of a smaller version of Keppel. I mean, in our view. More interesting for me is really the data center, because that is more fundamental to their business. That one can maybe move the needle if they sell that out, because the demand is so high. So because basically some of these assets are trapped inside Singtel, and most of us only value all these assets at telco, at very low telco valuations, because they don't separate it. So how are we going to value you separately, right? So if they strip this out and separate out, then maybe they could get a higher valuations. But just to get back to your point, I think they will recycle some, but I don't think it will be that as major an impact. Because they mentioned in their charts is that out of the 6 billion that they recycle or sell, instead of recycle, maybe 4 to 5 billion will be used to reinvest in the business. Because the problem with the telco business is that you really need a lot of capex for 5G and so forth. So the other 1 billion will be used to pay back shareholders. That's what we mean by but and this will be more in the medium term rather than in the short term. What are your views on ThaiBev? Are the election results and new leadership generally positive? Okay, so for ThaiBev, I don't think the election will have any, whichever leadership. It's probably more or less. I mean, from ThaiBev's point of view, the impact on consumption of alcohol may not be different, but they did mention in their call that typically after the election, they might boost a bit more consumption of a be celebration. So this is the typical phenomena. But what I worry, the reason why we are always a bit hesitant on ThaiBev, at least in the medium term, is that there hasn't been any alcohol custom duty hike for some time. So that's why we are a bit conflicted. In the near term, you get two benefits. In the near term, you get, of course, so-called celebration. This is a more short-term thing. And the second near-term benefit is that whichever party win, they all mention about supporting consumption, giving out handouts, farm subsidies, incentives. So all parties are going to prime the consumer sector. So that was the benefit. But the only thing that why it holds us back is that any custom duty hikes. So there's always a bit of worry that they might impose custom duty hikes. And usually there's a bit of dip in the share price before they rebound, because volumes eventually will still rise. But that's the thing that causes some hesitancy for us on the share price. But near term, excluding that, demand should still be resilient. Yeah. Only thing that their beer business, which it's only like 10% of profits for now, is still going to be weak because of what's happening in Vietnam. which stocks might there be to Japan exposure before Parkway REIT? I think First REIT is probably one of the stocks. First REIT is also building a portfolio of retirement homes in Japan. As just as a side, retirement homes has a huge demand, not only because of the aging factor, because of culturally, because I think what was mentioned to me also, because in Japan, it's not like here they have helpers and so forth. So in Japan, you most of them do move into a hub because there isn't really much support for all this, apart from also a lot more government support and assistance. So that's why the demand there is also stronger, not just because of the aging factor. There's also cultural reasons. If palm oil products are poor in outlook, what about Bumi? Is it a sell? Yeah. We don't cover palm oil plantation companies, and one of the reasons, just as one of the interest reasons why we don't cover palm oil is because they are very well covered by the Malaysian analysts. I mean, because most of the palm oil stocks are based out of Malaysia, so it's always whoever covers palm oil in Singapore, you have to cover Malaysian palm oil. Otherwise, you are like covering half a sector. It's like instead of covering 3 banks, you're only covering 1.5 banks. So that's why we never really did any coverage on palm oil, because if we don't cover Malaysian palm oil, then there's no point covering palm oil stocks. But the outlook will be weak, and I think it's quite known already that palm oil demand is going to be soft. Yeah. Your views on Food Empire? I'm not sure if Miao have anything because you if you went for the briefing, but for Dynamac, the demand is strong because of the whole surge in FPSOs. I think the problem for Dynamac more is probably there's not enough supply, not enough capacity. But the demand should be strong, I think, the next 12 months, because after the lull in the last 2 years, there's going to be a huge pent-up demand in FPSOs, floating production units. There's apparently going to be one every year. I think last year the demand could double in terms of FPSOs, based on what SBM Offshore predicts. So if you go to SBM Offshore, which is so they are the ones who operate FPSOs. If you look at some of their slides, they are looking at very aggressive rollout of FPSOs. So that's why the outlook for Dynamac should be strong in the next 12 months. I'm not clear on on outlook for Food Empire. I'm not sure Miao got anything to say. Okay, prospects of China Aviation with tourism. Yeah, so we do like China Aviation because I think they under-earned, during the pandemic. But so for China Aviation, they got 2 parts of the business. My guess, I don't have the exact numbers in my hand, but maybe 60-70% of the earnings come from their associate, Shanghai Fueling. Basically, the petrol pump in Shanghai Airport, like we mentioned before. So that should rebound very strongly. Just like we highlighted before, it's just the trajectory, how fast, how slow. But when the outbound recovers, theirs is basically pure volume. They just earn a spread on the amount of. So basically, you're the only petrol pump to all the jet planes in the Shanghai Pudong Airport. So you will benefit from that. They used to earn as much as 80 million profit. So I think probably the pandemic, they will earn like 10-20 million. So there's very clear earnings growth, just the level will not particularly clear. So they're definitely a benefit, but it's just the timing of how fast China reopens up. Okay, due to very high rentals in general, most people renting now are seriously looking for alternatives. Once these people got their own residence, looks like the property owners will be faced reality when the Singapore become more competitive. Yeah. We do agree. Because last year the rents ran up about, I think, 30% officially. But the unknown right now is, like we mentioned in our quarterly strategy, is the population. So if you look at the so-called white paper, whether you want to believe it or not, but I think our population now is 5.7. The low case for white paper is at least 5.9 million by this year. So, and the government and the authorities build infrastructure for I'm probably going to be misquoted here, but I think maybe like 6.4 million population. So we think, of course, nobody whisper, like we say, nobody whisper in our ear. We think the unknown will be the population. I won't be surprised if the population levels will surge up, be it foreign or PRs. Because we got so much infrastructure, we build it up for this much, but we are even below the so-called 2013 white paper low case. So we think the population numbers should surge. But again, this is just looking at numbers, and of course there are other, there are other reasons this may or may not happen. Others, yeah. So, but there's a swing. We think population could actually come up. Your views on FCT, CICT. If it's a FA view, then I'll pass it on to Darren for FA. If it's a TA, then do mention that, because sometimes we're not clear whether it's a FA or yeah. Thanks. I hand it over to Darren. Thanks.
Yeah, so for FCT and CICT, so FCT, CICT both are in retail, and CICT is in office as well. So for FCT, yeah, their most recent business first half update was very strong. Like they had nearly full portfolio occupancy and over 98%, if I remember correctly. Yeah, so it's almost full. And they also have good tenant sales that's recovering. It's been above pre-COVID levels for the past 1 or 2 years, and it's still growing, but we expect it to slow down. So tenant sales are resilient and shopper traffic is resilient as well. So the top line is, yes, operationally they are quite they are still quite resilient. For CICT, the suburban malls are similar to FCT, but for the downtown malls, we see the visitor arrivals help to boost the shopper traffic, as well as tenant sales for the downtown malls, which can result in higher rents that they can demand. So on the retail side, is still quite resilient for Singapore. But for CICT, the office space, we find there might be some headwinds, as even though the space is limited in Singapore, and there's still quite a lot of supply coming up from the IOI Central Boulevard Towers for CICT, and we think that the office rents had peaked in the most recent quarter at 11.75. So this 11.75 dollars per square foot for Grade A CBD office on average is actually all-time high. And we think it's peaked and will start to slow down, especially now that a lot of the tech sector is freeze hiring and such, and the weaker economy. Yeah, so might be a bit of headwinds there for the office space. Yeah, so that's my thoughts for FCT and CICT.
Yeah. Okay.
Hi, sorry. Should I
now,
add
please.
on for the food empire, Paul?
Yep. Okay.
Oh yeah, so for the first quarter, right, they had a very strong quarter, and their net margin was actually increased by 13.5%, and the management is guiding for a similar rate for this entire year. And also they anticipate very strong demand from the consumer side. They also abandoned the plan to enter into China due to not very stable politics, and yeah, their first quarter result was affected by the FX fluctuation, and since they already hedged pretty a large portion of it, so should be normalized for the rest of the year. Yeah, that's pretty much everything.
Oh, okay. Glenn, can you take on the Silver Lake? But just to give you some sense of for retail, even though retail sales in Singapore has done so well, but the rentals are a bit slower. I think from my understanding is just that retailers are still cautious. I think after the pandemic, after 3 years of weakness, I think retailers are still a bit more cautious. So that's why some of them only take very short-term lease terms. No, usually 3 years, but if you look at FCT's WALE, it's gone down to, I think it's around 2 years. So I think that's why you don't really see the rental rising as much. I thought rents would actually rise faster for malls because retail spend so much, but I think there's still a bit of hesitancy. After 3 years of the weakness, then you got one good year, you can't push the tenant, now you have to pay. So I think that's what's happening on the ground. So I think any meaningful jump in retail, although it's definitely resilient and improving, you might probably see it in the next 2 years. Probably need another one more cycle because retail has been so bad the last 3 years. So everyone is still very cautious. When it comes to their tenant negotiations. Glenn, there's one question on Silverlake on the chat side.
Oh yeah. Sorry, I just noticed the chat side. Okay. The question being, why Silverlake Axis share price keeps coming down? Okay, so there might be many reasons, but I mean, just based off their last quarter results, I think it was about 2 weeks ago. So this is their third quarter FY23. So if you look at their third quarter results, just the third quarter alone, based year on year, if you see most of their I would say their software licensing dipped and their cost of sales increased quite a bit, which resulted in a dip in their PATMI. So this is mainly due to the higher operating expense. So their operating expense increased. So their OPEX increased by 14%, which more than offset the increases in their recurring revenue, which is their maintenance and enhancement services, which is their largest bulk of their revenue. So I mean, the higher OPEX is sort of to be expected with the current environment, and they had to increase their staff costs and finance costs due to the high interest rates, as well as they also had foreign currency exchange loss because they are based in Malaysia. So this was one of the, I would say, negatives for their third quarter results, and that might be also one of the reasons why their share price has come down, as maybe people are slightly worried. But if you look on the positives, you can see that they mentioned that they have recently signed their first multi-million 10-year core and Mobius deal with quite a large client in Malaysia. And they said that this deal is more than 100 million ringgit and 30 to 40 million will be booked in the first year. So I think it will continue to stream in for the next few quarters. And we should see that, sort of offset the increase in their OPEX. And also, you see how they are sort of marketing their Mobius, and with currently there are few core banking systems which are nearing their end of life. So, this will be a huge opportunity for Silverlake to push Mobius, because now the barriers to entry, which is mainly time and cost, because a lot of the banks don't want to sort of change their core banking system. It's like changing your whole house basically is going to cost a lot, plus it will take a long time. But now with the end of life of their current core, so it's like suddenly your current house you're staying in is very worn down and torn down, and the government's going to like take back the house, so you have no choice. So, this might be a very large opportunity for them to push their Mobius core, which is not really been seen yet, where they use Mobius as a full core instead. So we see these two opportunities for them as the major push for Silverlake going into the medium term, at least, where they can firstly continue working on the Mobius, which they have just locked down, the one in Malaysia, and they can also push this Mobius core to the companies, to the banks or companies which have core banking systems which are reaching their end of life. Yeah, I hope that answered your question. Thanks.
Yeah, there's a follow-up question on FCT. Hi, Darren, despite the resilient results, the share price for FCT is still not quite recovered from pre-COVID levels. What is your take and what's causing this? Yeah, so right now for REITs, right, if you can perform operationally well, it's really considered a very good thing. But then because fundamentally they're still affected by the high interest costs, so that's the biggest overhang for REITs now. Yeah, so if you consider if you can perform operationally very good, is considered overall flattish as you are still impacted by the high interest rate. And for FCT, in their case, they have about 1/3 of their loans expiring within the next 2 years. So they have to refinance this, and when they do that, it will probably be at higher levels. I mean, definitely will be higher levels than original when they signed the original lease. I mean when they took up the original loan, and we think it could be around 4% level. So this will kind of shoot up their overall cost of debt as well. Yeah, so the biggest issue for REITs is still the interest rate headwinds. But I guess the good thing for them now is that the Fed possibly might have stopped the hiking cycle, and yeah, that could be a catalyst for the REITs, especially if the Fed kind of starts lowering the rates maybe next year or the year after. Yeah, but fundamentally the high interest rate will still affect REITs within the next 1 or 2 years. Yeah, but having said that, the yield spread has expanded, so we are seeing that REITs are more attractive than it was before, especially at the start of the year or even last year. I think if I'm not wrong, the yield spread has went back to its 10-year historical average already. Yeah, so that's all for me. Thanks.
Max, you want to take the question, then we move on to all the technicals.
Sure. There's this question: is it too late to consider buying the AI and semiconductor-related stocks in the US, for example, like NVIDIA, Marvell, AMD, and Microsoft? Would you see them continuing to go up in the long run? Yeah, so I'll give my comments on NVIDIA and AMD. Maybe some for AMD, but not sure how Marvell is benefiting from this trend. Although they are in the connectivity business. Maybe hand over the time for Ambrish to talk about Microsoft later if there's any further comments. But generally for NVIDIA and AMD, if you talk about long term, then if you believe that AI is going to take off further, then these two stocks are going to be the main beneficiary, because as companies build more data centers, all the servers need more GPUs as well as CPUs. But however, they're gonna need more GPUs apart from CPUs, because I guess like one CPU can support multiple GPUs. But yeah, so I guess in the AI race, maybe NVIDIA is going to be the main beneficiary, followed by CPU makers such as AMD. And for Marvell, I'm not quite sure how they are going to benefit from this, because NVIDIA itself also offers connectivity hardware and software also. So yeah, if it's in the long run, then I guess if AI is going to be more successful, then these two stocks is definitely going to benefit further. Ambrish, I'm not sure whether you have any further comments for Microsoft.
Sure, Max. So sorry. So for Microsoft, the two main growth drivers, they are in the near term, they would be mainly it's Azure cloud service product and its Office 365 product. So in the near term, the AI should not contribute significantly to its top line growth in the near term. So we will have to wait. Microsoft, it has integrated AI into its Bing and its Office 365, but we still have to wait and see how it can contribute to its top line growth in the near term. Yeah, that's all. Thank you.
Thanks, Ambrish. I'll now go back to the sharing about technicals. Okay, so I'll talk about first one is STAC. So for STAC, we actually made a new low over here last week. So currently we are doing a bit of rebound. I think previous supports around here about the 70 cents to about 73 cent level will probably act as a short-term resistance for now in the current downtrend for STAC. Okay, then the next one will be Propnex. So for Propnex, last week we continue on the rebound from following a retest of these 96.5 cents lows. So for now there's a near-term resistance level close to about 111 to about 112 over here, which was this high over here. So could expect some resistance coming in possibly at this level. Next, CapitaLand Investment. Okay, CLI, I think price is actually moving a little bit sideways following this recent downtrend movement. Could be getting some support from this previous resistance, providing some support around the $3.45 level. So if you do hold the recent lows at 340, I think we could do a little bit of a range over here. But if you don't, I think the price might continue to move lower to possibly retest possibly this next swing low closer to about 330 over here. And then for CapitaLand Escort Trust, I think last week we had a rebound. Then we retested this strong resistance at 109 to about 110. Then we are coming down again. So for now, looks like a very classic range trade over here. Probably might retest the swing low near 103 again over here. So we are likely to just dangle in this region over here for CapitaLand Escort. Then as for Ascenders, we had a breakdown of this trend line support over here. Then we actually touching this horizontal level at about 270, which was a support over here of previous resistance. So if price can hold over here, I think we might do a little bit of a range where the resistance will probably be around 275 or to about 277 over here. But if it fail to hold this range, there's a chance that we could retest the next lower low, which is around closer to 260, this swing low over here back in middle of March this year. What are the supports and resistance for Shun Tak Properties and New World Developments? For Shun Tak Holdings, I think currently we actually retested 128 over here, this previous resistance. So there's a chance that price could rebound from this level over here. For now, we still haven't seen some form of bullish divergence taking place in this current downtrend. So we need to see that for more further price action. If it rebounds, I think current resistance would possibly likely to be at 138, which is this support we actually broke down from. If we can't hold at this level, then the next support level will be around close to 116, which is this swing low over here. And then possibly a retest of this wedge support over here as well for Shun Tak. And then as for new world developments. Okay, for New World, I think could be finding some support based on retest of this swing low near 1870, and this was a previous this resistance level we actually broke out from over here. So I think this might be a good support for the time being. Resistance wise, I think we could be looking at about 20 to about 2060 over here, which is this swing low as well as previous swing low over here. Then we could also have this downtrend resistance line over here acting as some resistance, which could confirm the short-term resistance around these levels. Okay, for CDL technicals. And for CDL, currently we are facing a pullback from a retest of this previous support mountain resistance at around 710. With the fact that this is a downtrend line resistance. So for now, support will probably, if you do retest the recent lows around the 660s to about 670 over here, we might have some support coming in. But I would expect resistance from about 690 onwards for now on here. So likely to do a range trade for city developments for now. Okay, then there's a question on Samudera Shipping, TA to 10 2023. I think I'm unable to give such a TA for a very, very long time frame since we are still not even yet the halfway mark this year, but I'll try my best to provide as a longer term time frame. So for now, you can see from the big picture, this was previous resistance around 86 cents to about 92 cents over here. We are just doing, and for now, price has actually corrected, and we are retesting this previous resistance, finding some support over here for now. So for now, probably gonna do a range with a resistance close to about 98 cents over here. Then we also have this downtrend resistance line acting on it. So the future, the trend for longer time frame will depend on whether we are able to break out of this trend, this downtrend resistance to possibly trade higher, or if we still find resistance over here, then the price might continue this downtrend momentum over here. So it all depends. It still needs some time to figure out how this might shape up in the future. Yeah. But for now, I can tell you, I think probably the range trade will probably continue for some of the time being. Okay, then for Mapletree Industrial Trust, Mapletree Industrial, we broke down of this uptrend support line over here recently. Then for now, there's the support is around 220 to about 225 this zone over here, since previous resistance swing low supports over here. So we do find support over here, we might do a real range with the resistance close to about 232 over here onwards. Yeah. Okay, then how about view on Alibaba? Okay, Alibaba, we actually retested the support level again around $78. But you can see there's still weakness as for every rebound over here, we are making lower highs. And so for now, we could see some support coming in over here, but still need some form of confirmation that we haven't had a bullish candle or seen a sort of rebound. Over here wise, looking at technical wise, I think still having a fresh negative crossover as well. So no sign of confirmation. So if we do hold this support, I think we could bounce to about $84 to about 88 over here. But if you don't hold, then there's a chance that we do test the next support level around close to 70 to 71, which was this previous resistance and support area about October to November of last year. So still need more clues to come for Alibaba. Okay, then I'll give my PA views on FCT as well as CICT. For FCT we also looks like we broke down this uptrend support line again. Then short-term support-wise, there's this swing low at around 214. So we see whether that's able to hold. Resistance-wise, will probably coming from, I think, about 220 onwards to about 224 for now. Yeah. As for CICT, we're also showing a little bit of weakness as with all the REITs for now. Short-term resistance, I would think, is from $2 onwards to about 208. We are near a support, which was this previous resistance around the 197 to about 195 to about 197 zone. So over here, I would expect some support if you do retest it in the near term for CICT. So a little bit of a pullback, price just pulling back for now. Yeah, so I think that's all from me. I'll hand back my time to rest my colleague for the question on semiconductors in the chat.
Yeah. Okay. Thanks. So we just answered this last one, and then we can end it. What are the semiconductor-related companies in Singapore? Would companies like UMS and Venture benefit from the rally of semiconductor stocks in the US in the long run? Yeah. Okay. So the three big ones for Singapore is, of course, AEM, UMS, and also Franken. So they will benefit from this if not as accelerated computing or GPUs do well. But the bigger benefit is the increased outsourcing into Southeast Asia. So I think there's definitely when the next rebound comes, they will definitely do better because there's more programs. A lot of it is shifting out from China, coming into Singapore and Malaysia, and mainly Singapore and Malaysia, not so much Vietnam. So they will definitely benefit. I mean, not only from the whole rebound in semiconductor, but also from this new programs that they're working on, new customers. I mean, so they were working on one customer, then they will get two customers, so that when the rebound comes, I mean, they will get the benefit of the second customer. Just that you don't see the, you don't see the benefit of this second customer or second program because everything delayed. I mean, the market is very weak. So the second customer isn't even ramping for new projects. So because you don't have the new projects, so the demand is still weak. So when the rebound comes, they will get this additional driver from new projects. So that's what we mean. So these are the three main companies. Not so much venture. Venture is more contract manufacturing. Theirs is more assembly work, and they are working more on other industrial products and also healthcare products. So their concentration isn't as acute as the last three. Okay, with that, I'd like to thank everyone for your questions and for your time, and hope to see you next week, and wish everyone to have a good week ahead and have a good holiday break. Yeah, thanks everyone, and take care.